The U.S. stock market rallied today. We were up about 0.83% on the S&P 500. However, we were up much more substantially earlier in the session, and we sold off into the close, so kind of the opposite of yesterday. However, the move was strong enough to actually move the postures of several indices back into that bullish territory. Some of the enthusiasm was around a short-term agreement for a debt ceiling increase, so kind of kicking the can down the road towards December, but it seems like the stock market liked that here today. Also had some positive vibes coming out of Chinese stocks, and that had been one of the limiting areas of the market, so I think that helped boost spirits to a degree here today. So we'll take a look at all of that, see what it means for our posture. Then we'll get into our trade application example, where I wanted to focus on a security that was in a relatively strong sector and industry group for a bullish trend trade idea. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's October 7th, 2021. First of all, for those of you that are new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area and be sure you're signed up for our email distribution list, so that way you can be notified whenever we post the videos, and you also get the benefit of all the stocks that are giving you overbought and oversold cluster signals within the S&P 500 at the bottom of those emails. We actually talked about oversold clusters quite a bit in my question and answer session for premium members earlier today. Anyway, we also are heavy users of Twitter. For those of you that are not doing so already, I would encourage you to follow me at Brandon Van Zee. And we really appreciate those of you that support us through likes and retweets of these Market Outlook related posts over on Twitter. And then last but not least, we have a presence on Facebook. Feel free to check out our group at that web address in the logo in front of you. All right, let's jump into today's trade activity. And as you can see, I've got chart 4B pulled up here in front of us, which is our more traditional starting point since we didn't move more than 1% in either direction here today, which I guess is becoming more rare. It seems like we've had a lot of those 1% moves both up and down in recent weeks, but today we finished just below that hurdle rate. And so we'll start off with kind of our traditional view here. You can see that the S&P 500, which as I mentioned in the intro was up 0.83% today, was up enough to change the background color from dark pink, which signifies strongly bearish intermediate posture according to the market forecast when you have that green line in the lower reversal zone, and now has transitioned into light green, and that suggests that we now have a weekly bullish posture. Not strongly bullish yet, but at least weekly bullish as we are merging out of that lower reversal zone there with that green line. So it's a start. Whether we're going to get too ambitious with this move remains to be seen. As I mentioned in the intro, we did sell off towards the end of the session, so that kind of left a little bit of a bad taste in the mouth. Notice that today's candle on the S&P 500, let me right click on this and maximize it so we can see this a little bit better. But here's what today's candle looked like, and look at yesterday's. It's almost an exact opposite of one another, where yesterday we had a long lower shadow signifying that the bears wanted to control the price action, but the bulls overwhelmed them and closed the session near the highs of the session. Today was kind of the opposite. We've got this gap higher where it looked like the bulls were going to be off and running, but the long upper shadow signifies that the bears were still around and still pressuring market behavior and actually closed us kind of in the middle of the range here today. You can also see that that occurred somewhat closely to where we have a bit of a resistance area, which at this point could be considered that downtrending 30-day moving average. So notice that the moving average stays red at this point, but we do have that bullish posture, so weekly bullish posture. But keep this in mind as well. Over here, in kind of the late September time period, we had 2 or 3 days where the market did transition from dark pink into light green, and it did not hold because we could not overtake that falling 30-day moving average at that time, and that could very well be the case right here. So that's an important area right there. If we can kind of prove that the market can stay above that moving average for a few days, I think the mindset around the market will change substantially. But right now, it's kind of one of those markets where it's hard to trust it because you can clearly see that we have a pathway of lower highs and lower lows that's been formed here ever since topping out at the beginning of September. So obviously the stock market has done this countless times in the last decade as the U.S. markets have been rallying. Some of you might have just seen my tweet here a moment ago about how the U.S. stock markets have completely dwarfed all of the other major economies around the world and how rare that is. So we've been treated well here in the United States in terms of the types of companies that we have access to. And it is true that the vast majority of times in the past where you've had a pullback like we're experiencing right now, those are moments to buy the market, not to sell it. But we always have to be a bit cautious, knowing that stocks don't grow to the sky. This is only a 5% give back that we've had so far. We have not yet gone past a 10% give back, and typically there is one of those every year throughout history. Now, sometimes you might have two 10% pullbacks in a year and none the next year, so it doesn't have to happen every calendar year. But if you were to average it out, typically we do have a 10% pullback each year, and we have not experienced that here in the stock market in this past year. So perhaps this is just part of that process working itself out right now because stocks don't go straight up or straight down. So that's why we always have to be cautious, use our head whenever possible, and most importantly, position size towards what your goals and your risk tolerance levels are and different things like that. So a little bit more positive news here today as we did get back into that weekly bullish posture, but I think we still have work to do. Let's see what happens if we can start getting above that moving average and whether the market is willing to let that hold. And if so, then I think that bodes well for the rest of the year. But October's a long month, and we might very well have a bit more chop and slop before that gets figured out. So we'll keep you posted here in these videos as always. Let's go ahead and take a look here at the Dow Jones Industrial Average now. Somewhat similar to the S&P 500, it was up today, but not quite 1%. In this case, 0.98%, which is a little bit better than the S&P 500. And the activity out of the Dow has been a little bit more resilient in the last couple of days. I mentioned that when I did the video for you guys on Tuesday right here. That was the day that we transitioned to that weekly bullish posture from that strongly bearish posture. Well, the good news is the last 2 days have not done anything to disrupt that. We continue to have that weekly bullish posture. In fact, that green line is starting to get a little closer to the 50th percentile there. Remember, once it crosses up and above 50th percentile, then we'll go into that darker shade of green there. And this one has a more decent chance at pulling that off. You can see here today we actually did close above the 30-day moving average. Now you'll notice that it still shared that commonality with the S&P 500, that we have that long upper shadow saying that the bears weren't just rolling over and giving up. They're still there. They're still battling against the bulls. So this remains to be seen who's going to win the war. But what I would point out is that we still have a slightly lower high from this candle over here on September 27th on the Dow. We were not able to breach the high or the close of that candle. So that might be an important one that we'll look back to, particularly if the stock market responds poorly to the jobs number and unemployment number tomorrow, where sometimes if the market's not ready to accept that with open arms, it gets sold off hard on days like that. So we'll just have to see how the stock market responds. But if it is a negative reaction from the stock market tomorrow, then we might very well look back and say, yes, that was a very important candle. So again, some good things to take away from today's price activity. In the case of the Dow Jones Industrial Average, it's even been a little bit more resilient than the S&P 500. This is now our third day of weekly bullish posture, and at least in this case, we can say that it did close above that moving average. The moving average is still falling, which is why it's yellow today. Yesterday it was red because price was still below the falling moving average. Moving average is still falling today, but we closed above it. So that's the first time that we've kind of tested that color change philosophy there. You can see that this other move that we've had has been consistently red. Even on that day right there, because we closed in the middle of the range, it continued to be painted red as that moving average there. So that's a little bit more of an optimistic view right there. We'll see where it takes us. Again, hard to get overly excited about it because there's been so much selling here recently, and usually that just doesn't get completely washed away with a snap of a fingers. But at least there are some positive takeaways here today, which we haven't had a whole lot of opportunities to discuss those in recent weeks. Let's go ahead and take a look at our next chart now. This is the Nasdaq Composite. It was up over 1% today, 1.05% to be exact. But remember, it's been blasted a lot more to the downside. So this could very well be just a situation where you get a little bit more of an aggressive snapback on that stretching rubber band, right? This is still an area that is struggling, similar to the S&P 500. It did go to the weekly bullish posture today, so hey, that's a start. We got to start somewhere if we're ever going to turn it around. Whether this is the move that gets us to kind of course correct back into an uptrend remains to be seen. I have my doubts at this moment. Again, my mindset and my expectation is that October will continue to be choppy, and then I'm expecting good things out of the market as we head towards the end of the year. So will it start now, or is it going to take a few more weeks? That remains to be seen, but I still think I'm in the camp of it's going to take a little bit of giddy up and go here in the coming weeks before we can kind of get back into a more strong stock market trend like we were experiencing through much of the summer. So great to see a nice rebound here today where we got that green line up and out of the lower reversal zone, and change that background color to light green with a weekly bullish posture. However, still trading well below that falling 30-day moving average right there. Keep in mind that the Nasdaq Composite is one of the more speculative indices out there, as it does contain a lot of tech stocks and a lot of growth stocks. So these things can change quickly. Just like over here when it looked like we were on top of the world and couldn't ruin the trend, well, that unwound quickly and got aggressively bearish in a hurry as well. So who knows? Maybe this is a really aggressive bounce that we have on the horizon. But similar to the other two indices, we have this long upper shadow here today saying that the bears were willing to sell off the most impressive prices throughout the day and not have the bulls have a complete win when it was all said and done. And then last but not least, we do have the Russell 2000. And remember, the Russell 2000 has been the one that's really held up over the last month the best out of these four. Part of the reason, at least my belief, part of the reason behind that is because they didn't get carried away with outrageous valuations throughout the summer like the mega cap indices did. So this pullback that we've seen since the beginning of September has really just been a profit-taking opportunity for too aggressive of bullish activity for the mega caps. For the small caps, they never had that aggressive push higher throughout much of the summer like the others did, so they didn't have to give back as much either. So you can see that it was another impressive day for the Russell 2000. It actually led all markets today with a 1.59% move higher. Not only that, but we had a couple of important changes on the chart that you'll want to be aware of. Yesterday, we had a strongly bearish posture because that green line popped below the 50th percentile just briefly. And then today, a huge snapback rally where we were up 1.5%. That was enough to drag that green line back above the 50th percentile. And since it's pointing higher, we would now consider that to be strongly bullish. Not only that, but notice the background color of the moving average. We've actually seen all three colors in the last 3 days. A couple days ago, we were yellow when price was below a rising moving average. Yesterday, we were red when price was below a falling moving average. And just like that, today, we're back to green when price is above a rising moving average. So you don't see that type of behavior all that often. But oftentimes, when it does occur, it's on a chart that's like this, where it is sideways, where one big move out of nowhere can change the shape of the 30-day moving average. average very quickly. Remember, with the other indices, we don't have that opportunity because they've been trending more often. So it's hard to have one single day out of 30 days move the entire trajectory of the moving average. But when the moving average has been kind of stuck somewhat going sideways, or the price behavior has, then one single big day like today can have that impact on the 30-day moving average there. So we're back to strongly bullish posture, intermediate posture on the Russell 2000, and we're trading back above that rising 30-day moving average. Now, just because this one looks the best out of all of them doesn't necessarily mean that this is a great looking chart. I think we can all look at this and see, yeah, it is more of a sideways chart here, and until we start breaking out of this range, it's going to be hard to get excited about trading the trends within the small caps. So if we could get back up here to 2,300 on Russell 2000, I think there would be some enthusiasm around this move. But until then, you kind of have to look at this as kind of just noise, more of a sideways type of behavior right there. Let's go ahead and take a look at the 3 green arrows chart now. And the 3 green arrows chart will be chart 4D for those of you that are premium members following along at home. And some good news here. We've got a couple of 3 green arrows setups to report on both the Dow Jones Industrial Average and the Russell 2000. Notice that both of those charts now have that light green background color, suggesting that we now have a 3 green arrows trade setup. Now, 3 green arrows is just a colorful way to describe bullish positioning of 3 different technical indicators: the 30-day moving average, the MACD histogram, and the stochastic. And so what this is telling us here is that price has now moved above what the average of the last 30 days is. So that's usually a bullish sign. We can see that the MACD is suggesting that we've had some recent price momentum that has helped the bulls kind of win a few battles here recently. And then the stochastic green arrow is suggesting that we're starting to close near the highs of recent ranges, which is typically a bullish feature as well. Now, when we look at this chart, typically we would apply something like a 3 green arrows analysis to an uptrending security. And in this case, I don't know if I can necessarily get away with saying that. Now, if you dig deep into the Dow, I'm sure there are maybe oil companies like Chevron, or perhaps some financial companies like JP Morgan or Goldman Sachs that might be able to be used as a kind of a proxy for the Dow Jones that do have uptrends in place. But you kind of have to pick through because there's a wide diversion of results and performances that have taken place depending upon sectors and industries and things like that. So I don't necessarily think of this as the ideal trend trading environment that we find ourselves in right now. Nonetheless, there might be some opportunities here and there if you're willing to look under the hood a little bit. Russell 2000 perhaps looks a little bit better with its 3 green arrows because at least there we do have the rising 30-day moving average to kind of attach to those 3 green arrows. So while it's not the world's strongest trend here, at least you could kind of envision that it was basing here, stabilizing, and now working off of its sideways behavior. So if we are to get an upward tilt into the stock market towards the end of the year, you might very well see that the Russell 2000 could be leading the way during that moment in time. And remember, small caps do tend to outperform kind of in that December, January time period. So be on the lookout for that possibility as we approach the end of the year. It's kind of crazy to think we're in the 4th quarter here of 2021 all of a sudden, so we need to start thinking in those terms. All right, let's go ahead and get on over here to the internet real briefly. I always like to get a chance to say thank you to those of you that help support us here with this project. As I always mention, we don't make any money off of doing these videos, yet it takes about 3 hours out of our day. And so we just simply ask you to help support this project if you want us to continue to do them. As long as we're getting up and over 100 likes on Twitter, I'm happy to do the videos and I'll make it a priority. If we're less than 100 likes, then I'll just have to kind of look at my schedule that day to see if I can fit it in or not. So you guys have been doing a great job on that count lately, so thank you very much to the 110 of you that took the 5 seconds out of your day to simply click like for us there on Twitter the last time I did the video there on Tuesday. I hope you can do that for me once again. In fact, get in the habit of doing it, and I'm sure many of you 110 are in just that habit where you want to support both David and I, and you'll be clicking like pretty much every day, because even if you're not watching the video, you'll know that it'll benefit you in the future on the days when you do want to watch the video. So thank you to all of you that have supported us along the way. We couldn't do it without you. Also, we had a busy day here At Market Scholars, David taught his portfolio management with ETFs class in the afternoon, and I taught my question and answer session in the morning. It turned out to be quite the marathon session, about 3.5 hours worth of question and answer there. So some good thorough analysis, hopefully. So if you're a premium member and you want to check out my answers to these questions, that recording is now posted. We discussed a lot of different things here today, including which ETFs to look for in various portfolios, also looking for some scans and some other ways to think about how do we sell puts on high quality stocks on big market sell-off days, which we've had here recently. Also had a question on how do we analyze a chart or the stock selector tool to be able to determine if a company has run its course and could fizzle out. Also had a long discussion about Editas and CRISPR in general and some of my thoughts after seeing the disappointing news, to put it mildly, of last week's data release there for Editas and what that means for the entire CRISPR space and some of those companies that I'm interested in from kind of a basket approach within the CRISPR biotech space there. Also got a question on Affirm, the buy now, pay later company that's been doing quite well here recently. Also talked about using a stink bid strategy for options for long-term investors class where we're selling puts. Also had a question about analyzing Intuitive Surgical now that the stock split is behind us, and looking at some different options techniques perhaps to look at there with their earnings announcement on the horizon, and then also a discussion on selling calls when the market is up. So lots of variety there for us today. For those of you that want to check that information out, again, that is exclusive to those of you that are premium members of Market Scholars. All right, let's go ahead and take a look quickly at the factor selector tool here as well. This was posted on Wednesday morning, but it uses Tuesday night's information. So a couple days stale here, but not too bad. Gives us a general idea, and you can see that once again momentum hung to the lead, probably just barely, as momentum is one of the more speculative factors out there that tends to get stung when the stock market's in a foul mood. This time around, it's actually held its own pretty nicely there. We also saw that value maintain the number 2 slot. That I am not surprised by. Both oil and financial stocks have been doing quite well on a relative basis here recently, and the value factor is chocked full of those types of sectors, and so that one was not as surprising. Dividend yield did make a move higher this week. Dividend yield and value do tend to kind of move in unison together, not necessarily in lockstep, but they usually do travel up and down this graphic together. So dividend yield starting to come to life here recently as well. On the downside, once again, low volatility is the cellar dweller. A lot of that is as a result of interest rate sensitivity. A lot of those low volatility stocks are utilities and REITs that tend to benefit when interest rates go down. Well, we've seen the opposite of that lately. Interest rates have been surging, and so those types of companies have kind of fallen by the wayside a bit. So anyway, there's your factor selector for this week as well. Let's get back on track now with some more Thinkorswim charts. Let's do some 12 grid analysis, starting with chart 5A. A reminder that the background colors of these charts will tell us what the current posture is for the using the market forecast technical indicator, specifically the intermediate posture. So as we're looking at this first set of 12 grids, you can see that we've got a little bit of a stronghold of green down towards the bottom. A couple of the same stories we've been sharing with you quite often here recently continues to be the case, which is the US dollar remains strong and US Treasury yields also remain strong. So those kind of corners of this 12 grid, with the US dollar in the lower left-hand corner, 10-year Treasury yield in the lower right-hand corner. You can see in particular the Treasury yield market was really smoking hot here today. Had a nice candle there where it was one of the bigger candles that we've had here in the last couple of weeks. And not only that, but we closed near the high of the session and basically at new multi-month highs, as you can see here on this chart. So remember on Thinkorswim, if you move that decimal point over to the left one on TNX, it will tell you what the current 10-year Treasury yield interest rate is right now, which is 1.57%. So again, doesn't sound like a big amount if you were to look at it through a multi-decade lens, but considering the ultra-low interest rate environment that the world has been grappling with in the last year or so, this is actually kind of on the higher end of the spectrum. And going back to what I had mentioned before, remember when treasury yields go up, it tends to benefit financial stocks on a relative basis, and it tends to hurt utilities and REITs that have that interest rate sensitivity. So it definitely has an impact. Just because you might only be a stock trader doesn't mean that you shouldn't be paying attention to some of these other macro features that are taking place out there, because a lot of it does kind of control the activities within the markets. You can see that oil was another big winner once again today, up another 2%. And we are firmly in the strongly bullish category there, with it trading above its rising 30-day moving average as well, whereas gold's kind of the opposite. Gold fell today. It was down 0.5% and remains stuck in that strongly bearish posture and is below a falling 30-day moving average there. So you are seeing kind of the traditional impact of a strong dollar on gold as a commodity. So notice how the dollar has gone up for the last 3 months. Gold as the commodity has gone down largely during that time period. So right now, we've got about another 8 days left of that iron condor that I have going on in gold. As long as it can stay above the lows of the August 10th there, we should be in good shape on that iron condor. But we'll just have to keep our eyes on that one, because it is definitely the lower end of that condor that's getting threatened. The upper end, we look like we're in good shape on that one. In terms of other charts that are worth mentioning here today, Bitcoin had kind of a bit of a stalling out day, but it did have a tremendous run in the last week, and therefore having a few days where it kind of fizzles is not the end of the world. It continues to be in a strongly bullish uptrend right here. Some of you might have seen my tweet earlier today where a Bitcoin ETF was finally approved here in the United States. Unfortunately, it's not an ETF that tracks the price of Bitcoin itself. It's an ETF that tracks companies like MicroStrategy and Mara and Riot Blockchain and those types of companies that are stocks that benefit from Bitcoin. So we're still not quite to the point of finding an actual ETF that tracks the price of Bitcoin here in the United States. We do have that trust, so GBTC is a fund. It's not necessarily an ETF like you're used to with other products, but this is about the closest way that you can easily track Bitcoin in your stock account if you're not willing to go and open up a futures account or open up a Coinbase account or something where you can buy your Bitcoin. So I know that's a challenge for a lot of us that are old school folks that like to conduct our financial business within our stock brokerage accounts. But I have a feeling that as the months roll on, eventually regulators will loosen their grip a little bit and will approve some legitimate Bitcoin ETFs going forward. And it has been a very nice move for a lot of those products here more recently. I wanted to also point out that the emerging markets had a really solid day. Now, it wasn't a good enough day to actually turn the posture around, so I don't want to make too much of it, but it was one of the big news stories of the day. You'll notice that EEM was up nearly 2% today, so well above the 0.78% move of the developed foreign stocks, and of course above what we experienced here in the United States as well by a factor of 2. So it kind of doubled the performance of the developed world here today. And so we've got some work to do here, but at least some signs of life. It does remain with that strongly bearish background color, and also the red moving average suggesting prices below a falling moving average there. Part of the reason behind that big surge is China. Here's just one example of that. Alibaba had quite the move today. It was up 8%. So there was some news that Charlie Munger had doubled down on his position here in recent months, and I think that kind of lit a fire under some of those Chinese names. KWeb is another way to look at Chinese internet names specifically through an ETF. You can see in this particular case, we actually did get a weekly bullish posture, as that background color did change there. So all of a sudden, some tiny signs of life here out of China, and that is exactly what EEM and the emerging markets in general have been waiting for, because China does dominate the emerging markets. And with China struggling as much as they had over the last several months, it just almost ensured that the emerging markets could not gain any traction. So now if China is willing to start stabilizing here, maybe we can see some benefit go towards these other emerging markets as well. Let's take a look at our sectors now. This will be chart 5C. And as you can see, we've got two dark green charts on the board, and those are the two we've been discussing more recently, which are the financials that are benefiting from a rising interest rate environment, and energy, which of course is benefiting from a surging crude oil environment. Other than those two, it's been hard for trends to take shape. Now, from a market cap perspective, discretionary doesn't look too bad either. You'll notice that discretionary had a very nice day where we were up 1.56%. That did push us back above a rising 30-day moving average there. So if I had to award kind of a third place at this moment, I think it's pretty clear that energy and financials are our top two gold and silver medalists. But if I were awarding a bronze out there right now, I guess I'd probably have to give it to consumer discretionary, at least on a market cap perspective. Remember, things can look a bit different on an equal weighted basis. But on this market cap weighted basis, using XLY as our proxy, where you have stocks like Home Depot, Tesla, and Amazon truly driving the vast majority of the behavior, we are at least setting up for a possible bounce up and off of that rising moving average there. And we can't make that claim for any of the other charts that we see here in front of us. In terms of the bearish charts, it is healthcare in the lower left and real estate in the lower right. Real estate is likely suffering as a result of rising interest rates that I had mentioned before. Healthcare could very well just be some profit taking there. Again, some of those CRISPR stocks and other biotech stocks really struggled here in the last couple of weeks because of some data releases. So that has a bit of an impact there. But truth be told, a lot of those biotech and CRISPR stocks don't really have the heft to move XLV. Remember, out of all of those CRISPR stocks, the only pure CRISPR stock that has a market cap of over $10 billion is Intellia. All the rest are mid-cap companies. So they don't really have the chance to move XLV. So I have a feeling that this move in XLV is probably as a result of what's been going on with Moderna. Moderna has been an absolute runaway success in the stock market over the past year, and you can see it's broken down in a big way here in the last couple of weeks. And so Moderna now has a market cap of over $100 billion. It is influential when it comes to its weighting within the XLV these days. So I think it's kind of that pricking of the bubble, so to speak, within Moderna and some of those other vaccine manufacturers that's putting a wet blanket on healthcare in general at this moment in time. All right, let's get into our trade application example now. And for that, I'm going to talk about a financial stock. So again, one of our two sectors that are showing that bright green color here. And you can see up here, financials trading above a rising 30-day moving average as well. What I'm going to do for this conversation is pull up our trend trading chart, chart 1A. This is the chart that I use for my top-down trend trading class on Mondays. So let's give it a moment here to load up. There is a lot of information on this chart, so it takes a couple of seconds to get up and running. There we go. And let's go ahead and pull up the stock in question, which is ticker symbol JEF, and this is Jeffries Financial Group. This one caught my eye today because it was the rare stock hitting a new 52-week high. You can see this tag up at the top of chart 1A says yearly high today. Remember, the stock market has been squashed in the last month or so, so there's not a whole lot of companies that are hitting 52-week highs on the reg like this one is here today. So that certainly caught my attention. While the rest of the market struggles to get back to where they were trading in mid-September, let alone beginning of September, this one is off to the races to the upside, which is generally a sign of relative outperformance. In fact, you can see that down below here with these three colored lines kind of moving from the lower end of the indicator up to the higher end of the indicator right here, which you can only go to 100%. So we're sitting here at basically like the 99th percentile on all three of those colored lines, effectively stating that this company, Jeffries, is vastly superior with its trading performance recently compared to the S&P 500, compared to the financial sector that has been benefiting itself recently from rising interest rates, and also better than the capital markets industry group. So all of those tightened up right up there near the 99th percentile. So this has been kind of a leadership stock, particularly recently, right? This summer, you couldn't have really gotten away with saying that. Notice how the price activity was below the purple line some moments along the way. That purple line represents the pathway of the S&P 500. So during this period of time, Jeffries was not an outperforming security. Really, where they've become an outperforming security is in the last month or so. During this time period right here, where they've maintained strength above that rising moving average at a time when the rest of the stock market is breaking down and forming downtrending moving averages. So this appears to be one of our leaders in this market. It's up about 26% over the last 6 months. And it also has a 5 green arrows signal because we have our green arrow there on the moving average. We have our green arrow there on the WAR score, which is an acronym that stands for weighted aggregate returns, which is a way that we can calculate relative strength on all of our stocks here at Market Scholars. And then we also have a green arrow on the MACD histogram, suggesting that we have some momentum surging into the company. We also have a green arrow on the stochastics, telling us that price is closing near the highs of its recent ranges. And we also have a green arrow right here on the market forecast with that green intermediate line in that upper reversal zone as it stands right now. So this is effectively what we're looking for. Of course, the big challenge is the stock market itself is not in an enthusiastic mood, but that can change. And so we're kind of looking towards the future. And if the stock market can start stabilizing going forward, we have to start thinking about who our future leaders are going to be within the stock market. And Jeffries could very well be one of them. So what I did in this particular case is I just simply bought 100 shares, obviously position size for whatever's best for your own portfolio, but just bought shares of stock as a trend trade. And in this case, because I don't use the same type of rotational routine that I would normally be doing with my Monday class, I do have to have something kind of protecting my trade. So what I opted to do was put in an 11% trailing stop on this one. The reason I came up with 11%, by the way, is if I were to come over here and look at the zigzag chart, which is chart 6H for those of you that are premium members at home, and I type in Jeffries, or Jeff for the ticker symbol there, and I come up here and change the time period from 9 months daily to 9 months using a weekly aggregation period instead, you can kind of get a sense of some of those more intermediate types of moves. And you can see that this stock has had some decent pullbacks along the way, where you had an 8% pullback back here in June, 7% pullback here in May, a 10% pullback here in March, and then right at the beginning of this year, we did have an 11% pullback, or just shy of that, 10.74% to be exact. So in other words, by applying an 11% trailing stop, it would have allowed me to stay with this stock through any of this turbulence along the way. Obviously, that doesn't guarantee anything about its trading in the future, but at least can give us something to bank on in terms of what to expect out of this specific company's typical volatility. And usually in its moves lower this year, it has not moved lower by 11%. So it would allow us to kind of breathe and live in that trade for a little bit longer than we might have otherwise. Okay, so that's what I had for you here today. If you got value out of this presentation, if you learned a few things along the way, or just appreciate being kept in the loop in terms of some of the recent market activity, I ask one simple thing out of you. Simply click like for me there on Twitter. It only takes 5 seconds out of your day. And I think that's a pretty good trade-off for the 3 hours that I spent producing the video and doing the research and the prep work and the editing and the notifications and writing up the paragraph summary, sending out all of those emails and everything else that goes into this process. So if you appreciate the work that goes into it, that's a simple request that we could ask out of you, is just simply click like for us there on Twitter. All right, so David should be back with you tomorrow. I will be back with you on Tuesday in all likelihood, and look forward to seeing what the weekend brings in terms of our tools like the Stock Selector tool and the Sector Selector and things like that as well. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.